welcome. This is the Investor Coaching Show. Paul Winkler talking about the world of money, investing, retirement planning, financial planning. And actually, I had a question that came in that I'm going to get to in a second, but there was something else that I felt compelled to share. Telling the guys in the office this week, I says, there's this magazine that came in and I have to talk about it. So one of the publications, one of many financial publications I get, Financial Advisor magazine. I don't often talk about the magazine here on the show, but this is one I get and I'll peruse through it. And I saw this, you know how you ever get these magazines? And then on the front cover, you got whatever's on the magazine. But what they do is they paste another page on the front cover. So they have a page that they put this little sticky, gooey, gluey kind of stuff, but it doesn't, stick so hard that you can't just rip it off. But it's on there, and it's like the cover of the magazine normally. As a matter of fact, the logo of the magazine up in the corner, and they have everything there. But it's actually a cover on the cover, and it's just an ad. So I'm not going to cover that first because I think it actually makes more sense to come back to it. This magazine had one such cover on it. So actually, I'm going to pull it off, and I'm going to tell you what the actual cover said. And I want to walk through this because there was an article inside that I thought I would talk about a little bit in depth, because I think it's educational to hear a little bit about what the industry hears, people in the industry, the magazines that they read, and what is marketed, so to speak, to them from the investment industry side, where you'll have people writing articles, and this is a big area of education for many advisors. They go and read through these magazines. This one anyway had a cover story. It was, "Where Are the Retirees Yachts?" And this harkens back to something. It's actually a phrase that I've used on this show before, because it comes back to, there was an academic, and I don't remember exactly who this professor was, getting a tour of Wall Street. And getting this tour of Wall Street, he is down by the harbor, I guess, down there by the water. And this person points out to the water and says, "Hey, look out there. That's all the brokers' yachts." And the professor looks out there and goes, "Well, where are the clients' yachts?" He's looking around. And, good point. But this article is talking about the investment industry and some issues going on, and, just what some of the struggles are that the investing community or that the clients run into when it comes to planning for retirement. And the article, which was the cover story, says the financial advice industry is reporting record results, but most retirees will struggle. So the idea being that the investment firms are making money hand over fist, they're doing very, very well, but the clients aren't necessarily doing so well. And I've railed about that for 20 years here on the show, right? And you've heard me say why some of those problems are occurring. And, if you haven't, well, stay tuned, because I'm going to reiterate a few of these points that I think are so important. And why is it that the industry is doing so well, but the clients aren't doing so well? Well, it says retirement is here all around us. The median age of our clients is almost 70. Stories about clients' lack of financial literacy and preparedness are everywhere. The top advisors might reply, "Well, my clients are all set." Well, what about the other 97% of people not lucky enough or wealthy enough to earn the level of attention from skilled professionals? Most Americans are on their own. And this is so true because we go back, 50 years and everybody had a pension, right? So they didn't have to think about this stuff. And I've talked about how the problem is now people have to think about this stuff. And quite often what they do is they feel so ill-prepared to think about any of this retirement planning and investing and how to calculate the number that they need or how much money they need for retirement. They just blindly trust a financial community that may not necessarily be terribly trustworthy or terribly educated themselves. Let me take that back about trustworthy. It's not necessarily that I believe that the financial industry is trying to take advantage of people. Most of the time, they're just not terribly well educated themselves. And they're saying that the top advisors, they're fine. And they're probably, referring to that there is a group of people there are a group of people that are pretty well-educated advisors. Matter of fact, I had a friend of mine who was one of the professors at one of the universities and that teaches financial planning. And we got into a conversation about this. And I said, so what's it like? You go around the country and you meet with financial advisors in various places. What do you find? And he says, actually, Paul, he says, it was a shock to me because I was expecting that people would have a high level of knowledge in the industry and they didn't. It's because we're used to dealing with people like, you that have, because I have 8 different financial planning designations and all the people that work with me, all the different offices, we're all degree planners and we have multiple designations, most of us, in financial planning topics in addition to the regular financial planning designations, like certified financial planner, chartered financial consultant. But I always have my guys that go way beyond that. Registered registered investment advisors, great, but there isn't much to get that particular, Series 65. You just go and study for a few weeks and you got it. And that's all it takes to call yourself a financial advisor for most people. And a lot of people don't even have that, and they call themselves an advisor because they get an insurance license or something like that. But, getting a financial planning degree, good, great, go do that. But go get some of the other designations: wealth management certified professional, retirement income certified professional. We got people that are with us, enrolled agents. We have people that are dealing with, special needs planning, designated in that particular area. And, there's just a myriad of different designations that you can get on top of that, but making sure that they have the base of the financial planner. But he says, so often what happens is he goes out there and he finds that they don't have the level of knowledge that, he's used to seeing because he deals with degreed planners all day long in the college. And when we started getting out in the field, it was kind of a shock to his system. So what happens here is they're saying that 97% of people not lucky enough or wealthy enough to earn that level of attention. And you hear this kind of stuff, and unfortunately, where if you have $1 million or more, you got to have that much money. Now, some firms, it's just $250,000, but that's the level that they want you to have just because the commissions on anything less than that aren't enough to bother with you. My pet peeve, another pet peeve. But a lot of times what happens is people fall through the cracks. Now, one of the things that we do is we have a very efficient way of dealing with people through education systems and seminars and workshops and videos and things like that, where you don't have to have $10 million to work with a firm like ours. So that's something that I have consciously set up to be very, very different than what the industry at large is. So anyways, they're talking about how people don't get a great level of information, and a lot of it comes down to how the industry is run. If you think about it, when you ask somebody, ask a friend of yours. Now, if you're listening to the show here and you listen to this show a lot, it's not fair. You can't answer this question, but go ask a friend of yours. So what does the financial advisor do? What are the things that they do? What do you count on them for when it comes to investing, for example? And, getting me in the right areas of the market, getting me out of the wrong areas of the market when I don't need to be in different areas, or watching what's going on in the geopolitical scene, watching what's happened with various companies, what's happening with the stocks, choosing which stocks to hold, which funds, fund managers, keeping up on the fund managers. And, that is really, you look around and that's what you see happening. Or you see, investment managers buying index funds. And then what they're doing is they're changing the index funds and moving it around, or buying, funds that are investing in various sectors and sector funds, and then moving things around based on what's happening and what seems to be going on in various sectors like technology, like healthcare, like energy stocks, or moving things around in that way. And if you don't think that's what the advisor's doing, I always do this with people, and it shocks people when they do it. I tell them, go grab your statement. Grab your investment statement, most current one that you've got, and then go grab a statement from 3-4 years ago. And look at how many differences there are. You will normally find that the differences are stark. Then look inside the funds themselves. And you probably won't be able to find the information on the fund 4 to 5 years ago. There is a program that does allow you to actually look at that, Morningstar, but you have to pay for it. And then you can see Style Box history. This is something I often will teach financial advisors to do, is go look at the fund in the Style Box history. Now, it looks like a tic-tac-toe box, so you got 9 squares in it. And what you can see is that Morningstar will actually track what was the Style Box last year. What was it the year before that? What was the year before that? And one study I'd actually seen, and I have in my book, it was something like 76%. I forget. It was like 3/4 of mutual funds had changed their style in the last calendar year. So that is a form of market timing. So what's going on when it gets down to how the money is being managed, quite often it's that. It's a form of market timing. Now, market timing, you normally think of, I'm 100% in cash, and I think the stock market's going to go up. So I'm going to go and shift it all into the stock market to get in there before it goes up. Or, I got all my money in stocks, and I think the market's going to go down, so I pull my money out. That is the purest form of market timing. Market timing is typically not practiced that way in the investment industry. Normally, the way it's practiced is, hey, we're going to lean a little bit more with value stocks. You hear, I think that there's going to be a shift into value over the next coming period of time. And then you'll see fund managers start to shift more over there. I think international, it's time for that to do well. I think U.S. is going to do really well. I think, we need to be focusing more on large growth companies because they're more stable for this, whatever. They'll always have a really good reason to do what they're doing, but it is basically market timing because they're changing the mix of the portfolio based on a forecast or a prediction about the future. That is the pure definition of market timing. Then you can look at the funds and you can look at the turnover ratios inside the fund, buying and selling activity. And it's not unusual to see 60, 70% turnover inside of a fund. In other words, 70% of the stocks are different from what they were the calendar year before. So that's the type of stuff that you see. And that passes as investment advice. And that's typically what, you'll see I'm telling you, we have analyzed portfolios for a couple decades. And before that, you didn't want to talk to me because I was part of the problem. I was a broker as well before that. But, now, and if you look at the last 20 years, when we look at these portfolios, this is the type of stuff we see. An overabundance of one area of the market. For example, in recent years, it's large U.S. stocks. People are just overrun with large U.S. stocks. Now, in the late 80s, that wasn't what you saw. Believe it or not, what you saw in the late 80s was international. Investment advisors piling onto international stocks. And then in the 90s, U.S. stocks did better, and then they got burnt that way. It's just constantly timing in that way. So that's one of the things that I've pointed out for years here. Now, it says the number of people looking for and requiring assistance is rising, but most haven't prepared for the lifestyle that they want and will have to make adjustments in real time. And it's kind of like, instead of preparing ahead, it's reacting instead of acting when it comes to how most people actually engage in planning. Very, very true. Then it says, so there are 3 talks that they recommend in this article. Number 1 is good planning involves 3 talks, one about finances, one about investments, and one about family. Financial conversation addresses the nuts and bolts of how much we need, how much we have, income, expense realities associated with retirement. So how much am I going to need? And this is going to depend, how long are you going to live? You don't need much if, you're going to be around for 1 year, right? But you may need a whole lot more for a person that might be around 30 years in retirement. And that is not unheard of by any stretch of the imagination. Talked about that last week. I talked a little bit about the statistics on what percentage of people, if you have a couple, that one of them will be around to at least age 90. It's the vast majority. So you look at that and go, well, your money's going to have to last a while. And if it's all in fixed income investments, perish the thought of keeping pace with inflation. And then they had a professor from one of the colleges. He says, delaying retirement and continuing to work is the most effective way to shore up your leaky retirement plan. Well, this happens to be a guy that I disagree with a lot, so I'm not even going to say his name. But he often talks about annuities. Yeah, because they're taking your advice and buying And there aren't many. You get a couple financial these professors that will be, talk about annuities, and I wish it were none. Because sometimes annuities actually make sense. There are a couple times they make sense, but sometimes it just seems like you'll get a couple of them, and there are just a couple of them out there that will recommend them. And most are like, no, if you're putting your money in an annuity, it's all fixed income based, and the problem you run into is inflation eats your lunch over time. Because if you have inflation and your need for money doubles over the next 15 years, 20 years, or 10 years, and rate of inflation right now, it's even faster than that, your life income is dropping significantly before your eyes because the value of the dollar is dropping. And if you're using a fixed income investment, you don't have a hope of outpacing inflation. And what happens so often is the people out there selling these annuities that get really high commissions will parade in front of you the couple of professors in the country that are really big on them. I just don't know many, except for there's a couple. But anyway, this guy says, you need to keep working. Well, yeah, if you do what this guy normally talks about, yeah, you probably are going to have to continue working. And 90 years old, you'll still have to be work because your income from your fixed annuity isn't purchasing a fraction of what it used to. Anyway, I digress. I talk about those enough. Another professor, Boston University, says, he says, he's got a book on how to manage, and he talks about money magic is what his book title, I guess, is. How to manage for entire family for a unified managed household, tax planning integrated with investments, more precise healthcare estimates based on clients' actual health. And, that some of that is kind of valid, looking at those types of things. What is a person's health? As I've talked about before, if a person is in better health in retirement, the reality of it is that their healthcare expenses tend to be much less, not just for the most obvious reasons that they don't need healthcare as much, but they typically tend to square the curve, as I've talked about. If you're in really good health, you don't tend to go through that slow decline where you end up in a nursing home for many, many, many years. And I hearken back to a conversation I had with one of my clients that runs nursing homes that I talked about recently. And he said that, and I have another client of mine, who's a nutritionist, and she always talks about that, square the curve, eat well, exercise. And the reality of it is, if you look at the statistics and the reality of it, people don't tend to go through that long, slow decline where they end up in a nursing home for many, many years. Now, there are a few exceptions. There's always an exception to every rule, but that tends to be the case. Liquidity preparedness for big expenses and minimize disruption. Sometimes for liquidity, you're making sure that you have a little bit of cash on the sidelines for those liquidity expenses. But sometimes people will set up reverse mortgage lines of credit for liquidity and those types of need. Now, so in one of the quotes, it says that when people in the peak 65 generation entered the labor market in 1980, 60% of private sector workers relied on protected income from a pension plan. And now it's only 4%. And a lot of those people had pensions that have COLAs. Now, if you think about the annuities that are sold right now, you don't have COLAs on them. You don't have cost of living allowances on them. When you look at pensions, you don't see those COLAs except for in the government area. Sometimes you see those in that particular area, but a lot of people don't have that, so they're going to have to prepare themselves for this. Now, it says the investment conversation, like the financial conversation, this one involves considerable forecasting. Most notably, prognostications about the future performance of markets, interest rates, and inflation. Now, this is another area. They're saying in this whole article that the investment industry is problematic and a lot of the financial advice is problematic. There's part of the problem right there. What are they saying in this article? That they're trying to predict the future, prognostication, trying to predict the future. If we look at markets, and we go back through the Depression, 1920s until today, the average rate of return, the historic average rate of return through every single 30-year period, bar none, even the most recent 30-year period, which includes 20 years that was kind of rough, right? The rate of return for large U.S. stocks is about the same, within like 1% or 1.5%. If we look at pricing of stocks, what price they're selling for every dollar of earnings, we don't see differences compared to history. So what happens is some of this stuff that's being put out there is making dire predictions about the future. Well, why is it they're making dire predictions about the future? Well, dire predictions about the future sell products, and most notably tend to sell fixed products, which most notably tend to be the highest commission products out there and the highest paying products to the investment industry.